This is TechCrunch. Over the weekend, the winning runner at a Beijing half marathon for humanoid robots finished the race in 50 minutes and 26 seconds, significantly faster than the human world record of 57 minutes recently set by Jacob Kiplimo. Comparing human and robot running times may seem unfair. One social media user observed, "My car can outrun a cheetah." Still, the winning time is a massive improvement over last year's race when the fastest robot finished in 2 hours and 40 minutes. The Associated Press reported that this year's winner was built by Chinese smartphone maker Honor. It seems the winning robot was not actually the fastest, as a different Honor robot finished in 48 minutes and 19 seconds, but that one was remote controlled. The 50-minute, 26-second robot was autonomous and won due to weighted scoring. About 40% of participating robots competed autonomously, while the remaining 60% were remote controlled, according to Beijing's E-Town Tech Hub. Not all of them did as well as Honor's robots, with one robot falling at the starting line and another hitting a barrier. It happens in every emerging industry. Founders and investors push toward a common goal until the money starts to roll in and that shared vision begins to diverge. Cracks are emerging in the fusion power world, which TechCrunch's Tim DeShant saw firsthand at the Economist's Fusion Fest in London last week. It did not dampen the overall buoyant mood lifted by Fusion Startup's fundraising haul of $1.6 billion in the last year, but people had differing opinions on two key questions. When should Fusion startups go public, and are side businesses a distraction? Going public was at the top of everyone's minds. In the last 4 months, TAE Technologies and General Fusion had announced plans to merge with publicly traded companies. Both stand to receive hundreds of millions of dollars to keep their R&D efforts alive, and investors, some of whom have kept the faith for 20 years, finally see an opportunity to cash out. Not everyone is in agreement, though. Many that DeShant spoke to at the conference were worried that these companies were going public far too early and that they had not achieved key milestones that many view as vital in judging the progress of a fusion company. First, TAE announced its merger with Trump Media and Technology Group back in December. Though the deal is not yet completed, the Fusion side of the business has already received $200 million of a potential $300 million in cash from the deal, giving it some runway to continue planning its power plant. The remainder will reportedly land in its bank account once it files the S-4 form with the U.S. Securities and Exchange Commission. General Fusion said in January that it would go public via a reverse merger with a special purpose acquisition company. The deal could net the company $335 million and value the combined entity at $1 billion. Both companies could use the cash. Before the merger announcement, General Fusion was struggling to raise funds, and around this time last year it laid off 25% of its staff as CEO Greg Twinney posted a public letter pleading for investment. It received a brief reprieve in August when investors threw it a $22 million lifeline, but that sort of money does not last long in the fusion world, where equipment, experiments, and employees do not come cheap. TAE's position was not quite as dire, but it still required some funds. Pre-merger, the company raised nearly $2 billion, which sounds like a lot, but keep in mind the company is nearly 30 years old. What's more, its valuation pre-merger was $2 billion, according to PitchBook. Investors were breaking even at best. Neither company has hit scientific break-even, a key milestone that shows a reactor design has power plant potential. Many observers doubt they will hit that mark before other privately held startups do. One executive said that if they were in those shoes, they're not sure how they would fill time on quarterly earnings calls if the companies did not hit scientific break-even soon. If TAE or General Fusion does not deliver results, several people feared the public markets would sour on the entire fusion industry. Now, not all may be lost. TAE has already started marketing other products, including power electronics and radiation therapy for cancer. That could give the company some near-term revenue to placate shareholders. General Fusion, though, has not revealed any such plans. And therein lies another divide. Fusion companies remain split on whether they should pursue revenue now or wait until they have a working power plant. Some companies are embracing the opportunity to make money along the way. Not a bad strategy. Fusion is a long game, so why not improve your odds, right? Well, both Commonwealth Fusion Systems and Tokamak Energy have said they will be selling magnets. TAE and Shine Technologies are both in nuclear medicine. Other startups are worried that side hustles could become a distraction. Inertia Enterprises, for example, said that they're laser-focused on their power plant. Now, that jives with what another investor said months ago, that they were worried that fusion startups could get distracted by profitable but tangential businesses and then fall off the lead. There was not consensus on the right time to go public either. Some believe startups should first reach that scientific break-even milestone in which a fusion reaction generates more energy than it needs to ignite. No startup has achieved that yet. The other possibilities are facility break-even, when the reactor makes more energy than the entire site needs to operate, and commercial viability, when a reactor makes enough electrons to sell a meaningful amount to the grid. Now, there may be an answer to that question sooner rather than later. Commonwealth Fusion Systems expects it will hit scientific break-even sometime next year, and some think the company might use that as an opportunity to go public. That's all for now. For more stories like these, go to TechCrunch.com.